Welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank by applying the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sarah Ibrahim. With us today, I have Marc Beshears. He is the president of Top Wealth Agenda. He has helped his clients grow their wealth to achieve financial security and reach their personal and financial goals and dreams without the risk, worry, or volatility of stocks, real estate, and other investments. Marc has put his clients on track to building more than $50 million of additional wealth they most likely wouldn't have had through safe, proven financial strategies. That's why Marc's clients think of him as their secret weapon, helping them build and safeguard their wealth. Marc, welcome to our show.
Hey, great to be here, Siri. I really appreciate the invite.
Yeah. Thank you for joining us. It's nice to have a fellow bank on yourself professional. For the audience who don't know what bank on yourself is, you can go back to episodes 1, 7, and 24, where we talk about bank on yourself used in different ways. And this is exactly what this episode is going to be about. It's going to be about more of bank on yourself, more used in the way for employees and employers and other ways too. Marc, before we talk about bank on yourself in those settings, do you mind sharing with us more about your background and how you got into the specific niche of financial services?
Absolutely, because this was a journey I didn't plan for. It just happened, and it was all from financial pain that I experienced in my early days out of college, and that decade from 97 to 2007 was just such a rocky road for me. I didn't go to school for financial services, but I find myself here doing it because I'm like, how can you have so many financial factors go wrong in 10 years? And from age, let's call it 27 to 37, everything from the dot-com crash to 9/11 to the real estate crash, the mortgage meltdown, that was a whirlwind of a decade and it got me upset at the end of the day. I was looking for an alternative to growing wealth without all the sleepless nights. And one day, my real estate attorney, asked me if I had any cash value life insurance. And I was a little frustrated with his question, how that had anything to do with my asset protection. And he said, no, don't get upset. The cash value life insurance is creditor proof. Yep. So should you have any cash in there and things continue to get worse, nobody can get at it. And I was like, wow, that is rather interesting. Didn't know that fun fact. And one day, not too shortly thereafter, I heard the Bank on Yourself ad, a radio ad on one of the satellite radio stations. And I called the number and I dig into it and say, what is this? What are you talking about? It sounds too good to be true. And they said, well, we're talking about cash value life insurance. And so twice in the same week, I'm told to look into it. So I put my head down. In 2008, the whole real estate market and financial market was in such a tailspin. And I had time to research this concept, and I dug into it. And I said, if no one told me this was an option out of college, then I better start telling everybody I can, because that's how many people don't know about it as a easy way to grow your wealth, but then over time, then leverage that wealth into making returns that are easy returns without the frustrations of the market volatility. So I discovered it by accident, took it home and said, I'm doing this, and I'm going to set up shop, and the rest is history since 2009. And we've got hundreds of clients. And my favorite term to use is we're at a new all-time high today. Every one of my clients are at a new all-time high in their policies, and they can't screw it up. So it's pretty exciting. So that's how I heard of it, how I got involved. I've got multiple policies in my family, but then I'm also an entrepreneur along the way. So we can talk more about that as we dig in.
Yeah, absolutely. Thank you for sharing that story. And you dropped a lot of key points, like how your attorney asked you about if you had, this policy and asset protection. And a lot of people only think of life insurance as just life insurance, right? Cash value life insurance, or not even cash value. That a lot of people don't even know that life insurance policies have cash value. And if they're properly designed, right, the bank on yourself way. Do you mind sharing what that means? Like, what is exactly the bank on yourself concept in regards to using cash value whole life insurance?
Sure. Well, every dollar you earn needs a home.
Mhm.
It has to reside somewhere. And, you know, the old fashioned way is in your mattress, right? And then bank accounts, checking accounts, savings accounts, or investment accounts. And investment means you're introducing risk.
Mhm.
And what we're talking about it using life insurance, whole life insurance is a place where you can warehouse your money, where it's safe, secure, growing, and in your control. Keyword is in your control. Not to mention it has fantastic tax favorability
Mhm.
that we can definitely touch on. So the idea of bank on yourself is building your financial foundation rock solid, that no matter what other market forces are out there, your money is safe and growing and liquid.
Safe, growing, and liquid. I think that's probably one of the most important things, right, of running a business. Now, along with growing the wealth, right, securing it, protecting it, you can also leverage it to use for different places, other investments, other businesses. Do you mind sharing more on that?
Sure. This is the most interesting component. So it's one thing to make money, save money, and grow it for the future. But then how do we put the same dollar to work in multiple places? Here's where the real exciting part of having a properly structured policy is that with no questions asked, you can have access to that capital, roughly 90% of it, and borrow against that policy to use it for potentially an opportunity, or maybe it's an emergency. And when you leverage that policy, your policy still continues to grow as if you didn't borrow it. Whoa, there's a little game changer, right?
Mhm.
So my policy does not skip a beat of its compounding growth, even though I've borrowed against that plan to buy something, hopefully at a really good discount. And when you have that type of opportunity, it's all up to you and your creativity, how you want to leverage your own plan.
And I've heard that the example, like for example, if you had a house and the market value of the house was, let's just say $500,000, and then you borrow against the house, it does nothing to the market value, right? The market value grows whether you have a loan against it or not. And the
Right.
same is true, right, with whole life insurance.
Well, the one thing about the whole life insurance versus the value of your house is your house is not guaranteed to go up in value.
Yep.
And your policy will have guarantees to go up in value, plus a 100+ year track record of earning dividends without fail. So the idea of comparing the whole life to a real estate venture is not, it's oranges and apples there. One is rock solid and the other one is volatile with the ebbs and flows. I live in South Florida and I've been here 22 years and I've watched my neighbor's property double in value and then reduce by 60% to then double in value again to now you can't even touch it because the price has gone so up. So it's so volatile in real estate. But volatility is where you want to avoid it.
Yeah.
Except for on the falls.
Yeah.
When those good asset classes crash or reduce, that's when bank on yourself is your go-to weapon, because you can get access to that capital and buy those investments or properties or whatever it is on a discount. Many of my clients did so well leveraging their policy during COVID.
Yeah.
We saw Wall Street drop 35-40%. Could it get any cheaper? Maybe. But there were some bread and butter companies there that you could pick up. And so my clients who dipped into their policies and bought some pretty grade A stocks, we had no idea the market was going to rebound in 6 months. They were willing to wait, multiple years for it to rebound and make a strong return, but they benefited even better. And then once they got that money back, where'd they put it? Well, they just put it right back into their policies. No questions asked.
Yeah, I love that exact clear example, right? And this is where like thinking like a bank comes in, is that like during volatility, yeah, it's bad, but also it can lead to good things. Like I bet you that between 2007 and 2009, a lot of wealthy people became wealthier because of that, because they had access to cash. because if you had a real estate property that was worth 500,000, and then some sort of economic crash affects it, and then that price goes down to 250,000, so it lost half its value. It only makes sense, or it only helps people who have cash, access to cash, to buy it, because the banks are not going to loan against an asset that just dropped by 50%. It doesn't make sense from the lender's perspective. It's too volatile. And that's what happened in between 2007 and 2009, right? A lot of equities was tied up in homes because the market values dropped. Banks were lending against it. But if you come in with your whole life policy that has nothing to do with the stock market, it has nothing to do with real estate, you can leverage it, borrow against it, take out cash out of it, and then buy properties. Your cash keeps growing. And I love it too, because it's like you're living in your own banking system, not literally an FDIC insured bank, but it's kind of your own banking rules.
Source of funds.
Yep.
You got to have a source of funds, and banks are all well and good when times are good. And wait till, this recession we're maybe headed into, how the lending environment's going to tighten up like crazy. I got tired of kissing the rings to the bankers, back in the 2000s. It was brutal. And when the markets crashed, the lenders, those really nice lenders that would take you to lunch all the time, after the markets crashed, they were asking you to pay for lunch. It was brutal. And they call me for more business. But guess what? I've repositioned into whole life policies where I have my own source of funds, and I can just play golf with the bankers, but not borrow.
And it's counterintuitive, right? Banks give people who don't need money,
right?
But when people need the money, they absolutely will not give them. That's the last people banks want to give to.
That's so true. It's so true. And the lenders, they go on these calls there because that'll make their boss happy that they made so many calls. But they never planned on lending you $1. I've seen it happen.
It's a very interesting field, and this is where comes in, right? Bank on yourself, becoming your own banker. Now, I've heard from other bank on yourself professionals and other people who utilize this strategy, cash value life insurance, becoming their own banker. I've heard of some people that kind of still do both. They still have their life policies, they still leverage banks. Are you one of those people? Do you still, like, for some certain things, use banks, or are you trying to completely eliminate banks out of your life?
If you can eliminate them entirely out of your life, that's the best. That's the best. But on some other, when you get multiple ventures going at the same time, you may need a third-party lender for some line of credits, and just for the business venture itself, or if there's partnerships involved that I have bank on yourself policies, but they don't. So there's some negotiations that we can do between that. But no, I've gosh, how many different ways have I used a policy since I've got them started, more than 10, 11 years ago. The simple stuff is, purchasing my own cars, and then my cash flow just pays myself back. So I've eliminated that lender. That was fun. I've helped my kids through college. So I eliminated any of the student loan lenders. That was fun. They're gone. And business opportunities, you've heard about, or one of my business opportunities happened when there was an oil spill in the Gulf.
Oh, wow.
And I'm here in Southwest Florida, and tourism was just crushed because there's oil in the water. And a business opportunity arose. And do you think a bank would lend on a waterfront investment, but there's oil in the water? Never get by compliance, ever. But the opportunity is the price kept crashing and crashing because a lender would never touch it. So therefore it had to be a cash buyer. And we're so fortunate to do so. So business opportunities, I've gotten 3 businesses off the ground by using policies, policy loans, and the cash flow from those businesses is just returning back to those policies. And also the peace of mind from it, the tax and reporting and all that kind of stuff that you don't have to do compared to when you use a lender and they're in your books every 90 days because they have to pass compliance. Those guys are out of my hair. It goes on and on. How can you liberate from third-party lenders who are only there to make a profit at the end of the day, not save your family?
Yeah, they have reserves, right? And then they have to multiply that money. They can't just let that sit there, especially in a lower interest environment. They're not making money. They'll go bankrupt, So they
That's right.
have to lend that money out to other people and then multiply that money. The rule of 72, whatever the interest rate
Yeah.
is, divide that by 72. That's when you double, your money. So 3% interest, 72 divided by three, I think it's 24. So every 24 years, your money doubles and so on. The higher the interest rate, the shorter the period of time until you double your money. I think that's what the banking business is all about. It's how much money could we make in the shortest amount of time using other people's businesses, their ideas, their hard
Mhm.
work, their credit, everything.
Mhm.
My wife and I bought a house 6 months ago. It was our first time buying a house, first time dealing that closely with the bank. And we did everything right. The bank doesn't do anything. We give them the pay stubs, we give them the tax returns, we give them whatever they ask for multiple times. We're at their mercy to buy the house. We need them to buy the house,
Yeah,
and they're at an office somewhere. They don't have to put up any risk at all. Obviously, they have to invest in the property in the loan, but at the same time, everybody else does all the work.
that's right. That's right. Here's something I just remembered that I
Yeah.
did. There was a good friend of mine who was an architect, and he was breaking out from working for an architect, and he was setting up his own practice. And he was excellent at what he did, and I totally trust him. And he just needed some money for that expensive architectural software and
Uh-huh.
expensive architectural printers, making out those big blueprints. And he couldn't get a bank to loan on him because he had no revenue
Uh-huh.
history to report. So here he is trying so hard to get ahead, and the lenders aren't. You can go to small business and all that kind of stuff, but you got to give them your firstborn and all that kind of
Yeah.
stuff, and 4 pounds of paperwork.
Yeah.
So I just said, what's the offer the banks are even giving you for the $50,000 you need
Yeah.
for all this startup? Because I know you're going to be successful.
Yeah.
And he said, well, it's going to be about 8.5%, and it's got to be paid back in this town of time. And here's the monthly da 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 da
Yeah.
da. And I said, well, I believe in you. What if I'm the bank?
Mhm.
And we just had a handshake and a small promissory note,
Yeah.
between him and I. And I loaned him the money, and he paid me back in monthly installments. And remember, my original capital, even though I loaned it to him, is still earning its guarantees and dividends.
Mhm.
So there was another way I put some money to work from the policy.
So it was the terms were 8.5% interest
Yeah,
that he would pay you.
yeah,
And as of today, right, I think the companies we use, I think it's about 5% simple interest as of today. So that means that assuming that it was 5% interest that you bought your money at, you borrowed, you made a spread there, right? Between
sure.
5% and 8.5%.
Yep,
And you made money in your policy while it was
that's correct.
growing. The growth was never interrupted.
Correct. That's
You know?
correct. And it was peaceful.
Yeah.
It was a very small document between
Yeah.
he and I, just so that everyone knew
Yeah.
what the scorecard looked like. And he successfully repaid all the money, and
Okay,
my
good.
policy did its thing, and it's all success,
Yeah.
moving forward. And I would do it again.
Yeah. And I love that because it wasn't just about you making money, but it was also about your friend making money too. You helped him
Right.
launch his business where banks wouldn't, you're right. If there's no cash flow, no collateral, no land, banks don't
Right.
really care about that kind of business. I think
That's
it's like
right.
90% of small business loans get denied.
Right.
Only the ones with experience, cash flow, collateral. But here you are, you changed your friend's life. You believed in him and
Yep.
helped him launch his business.
That's right. Exactly. And one other way we've strategically helped one of my key employees. Um, you know, he was always getting recruited away from me, and I'm like, gosh, how am I going to stop this? And he'd come back to me, well, that company has a 401k and all that, and then it just dawned on me, well, we're going to set up a policy for you, and we, the business, are going to fund it for you. And here's what you're going to have when when you retire. Here's how much is going to be in there. And here's the cool thing is when you need it, when you retire, it's going to be tax-free dollars.
Mhm.
It's exciting. It's one of my favorite checks to write every year is to fund one of our key employees bonuses.
So let me just unpack some stuff. So number one, what is a key employee? What does that mean?
Well, obviously somebody that's vital to
Uh-huh.
your operation, and every business out there has them, whether you're a small company or a
Yeah.
big company. There's people you just can't afford to lose. And in this case, when your competitors are trying
Mhm.
to take away your people, how are you going to fend them off? Well, you got to be a little original, a little unique.
Mhm.
And with a properly structured policy, the cash value is building on the key employee's behalf.
Mhm.
And someday when they need to leave or need to retire, they're going to walk with it. In the meantime, the employee needs me to fund it.
Mhm.
So there's a little bit of a golden handcuffs there.
Yeah.
As long as I keep working, you'll keep putting money in that instrument. Absolutely. And it's there's a little agreement between the company and the employee.
Mhm. And then what's the what like for example, what is the agreement? Is it like they work for you for 10 years, 20 years?
Yeah, based on the age of the person and all
Yeah.
that. Typically, you want it something looking 10 years out
Mhm.
because no one knows where we're going to be in 10 years. And then obviously there's terms and agreements between, well, if he had to leave, what would happen?
Okay.
And that's all well and good. Things happen.
Yeah.
The other fun part is that you can also in the agreement allow the employee to have access to borrow against that plan, where it was so different than any of the other qualified plans
Yeah.
out there that are being offered. And maybe they need a new car, or maybe they need to put a kid through college. Well, we can have a liquidity availability to
Mhm.
that employee, which is just a game changer. And so that's for me and my employee.
Yeah.
Now, we've been also educating that to our business owners out
Mhm.
there. Obviously, the business owners need to know about this type of product because there's the buy-sell agreements between the partnership
Mhm.
that we could set up. And obviously, as the old joke is, I don't want to be partners with my partner's wife
Yeah.
if something ever happened to my partner. So the buy-sell agreements are very, very important to have if you don't have one out there. And I'm happy to help anybody get those set up. But then for the cool thing about using what's called the executive bonus plan or section 162
Uh-huh.
is that an employer can discriminate of who's eligible
Yes.
for these type of policies. That's a biggie because small business owners get suckered into putting in 401k plans because they think that's being competitive with their competition as they offer a 401k. Well, then the employers incurring fees and taxes and regulation, but they're also in that 401k plan has to be offered to everybody.
Mm-hmm.
And so there's a lot to unpack in that. By using the 162 executive bonus plan is the employer can predetermine who he wants to set these plans up for. So he doesn't get roped into all the minutia of these qualified government plans.
Mm-hmm. Can you provide an example of the executive 162 plan being used for one of your clients, for example?
Yeah, well, exactly the same as my employee, which is,
okay.
We're going to set up a policy on your life, and you're going to be the owner of the policy, but we're going to be the ones funding the policy.
Okay.
But to do that, we're going to have an agreement between us that establishes what you can do and can't do and what you're agreeing to do, to work here for a tenure of time, 5 years, 10 years, 20 years, whatever it may be. And the cool thing is to the employer, that is really payroll that is deductible to the employer. And to the employee, it's going in after tax dollars and will come out tax-free to the employee down the road. The one thing that we can also tell you, it's creditor proof again.
Yeah.
So if the employee got himself in trouble, that money is protected as well.
And if the company got in trouble, that money's protected.
That's exactly right. Then they all should just take the money and run.
Yeah. Yeah, because I think that somebody might, be like, all right, well, what if you guys go down? Then, it's still protected.
And to the employer side, the administration to run one of these plans is minimal compared to running a 401k plan. So I have several like medical practices, small, dentistry and things like that, that maybe there's 12 to 20 employees.
Yeah.
Well, setting up 401k plans is just not advantageous to the employer. So when you can have this type of savings vehicle, it's a win-win. Employees love it. The employer loves it.
Yeah, and I would even say it's not advantageous to the owner, the 401k, and not advantageous to the employees, really.
Yeah, there's no guarantee that money's going to grow.
There's no guarantee, and they have to pay taxes right in the future. They have to pay a tax penalty when they take money out under 59 and a half. The 401k loans are, if you think about it, they're taxed twice, right? Because when you take out that loan and then you're going to pay back with after-tax dollars, put the money back in with after-tax dollars, and then take out the money in retirement, taxable money in retirement. So it's taxed twice, the 401ks, 401k loans.
I agree. I call it a tax trap.
Yeah.
And you can't fight it.
Yeah.
It's no fun.
When you mentioned, for example, like if you had a company with 10 employees and you had to administer, I know there's very minimal administration for the executive plans, but is that something that you guys do? Do you guys manage the accounts?
Well, yeah, we stay in touch with our clients, sometimes monthly, sometimes semi-annually. It just depends on the needs. But, we do reviews, every year of how the policies are going. And obviously, if any of the employees want to look under the hood and see how much money's there, we're there to help. Now,
I kind of want to just go for a little bit further into the tax part, because I think that's really interesting. So let's just say I have an employee. I'm going to do a 10-year plan. I'm going to do $10,000 a year for this employee. I use company dollars to pay that $10,000.
Okay. That's right.
Okay.
And the employee, that's basically compensation.
Okay. Gotcha.
So that compensation is income to the employee.
Gotcha.
So some taxes are due on the employee's side.
Yes.
Just like you would if you took the money home, you would owe taxes. Well, now the money's going into a policy. And what some of our employers are doing to offset the tax, the income tax for the year, is they give them an extra bonus to cover what those taxes would be for that given year. So the employee would still see 10,000 going into the policy. Yeah. And the employee would, and I'm going to use 30% rule here for taxes, but it's close enough. So we gave him a $3,000 W-2 bonus in that year to cover that 10,000 that went into his policy for his current payroll taxes.
Now, Mark, as we're talking about, the control, the liquidity, not being affected by markets, being able to use this in an employee setting, benefiting the employer, benefiting the employee, why isn't everybody doing this?
So why is society conditioned to do all the wrong things? That's really the question. Who's pulling the puppet strings here? Yeah. There's so many advantages to having cash value, dividend paying life insurance in your personal financial toolbox, as well as your professional financial toolbox. So how are the big institutions in Wall Street, brainwashing society to and conditioned to say, I have some money, I want it to be worth more. So I'm conditioned, I guess I got to put it at risk in the market. And then you're told, oh yeah, and you're so young, even if it goes down, because you're young, you make time to make it up.
Yeah, time to make it up. And then which brings me to my next question is, what is the logic behind average rates of return, right? I guess it's that if somebody's young, they put money in the stock market, their funds go down, let's just say 30, 40% down, then over time, you'll average 8% or 9% or 10%, whatever the case is, giving you a 10% rate of return over that period of time. When in reality, that's not true, right?
That's right. And averages is a dangerous word in the financial world, and people are getting away bragging about averages or average rate of return was 9%. Really? Well, how much money do you still have in your policy or in your investment, Mr. Client? Well, actually, I have a little less than what I started with, but I made 9%. And unfortunately, people have actually bought into that and been conditioned to believe that word average rate of return. And it's just as simple. If you put $100 into an investment account and it went up 100%, well, 100% and it went up 100. So that's $100, right?
Yeah.
Your 100 went to 200.
Yeah.
And the next year, the investment went backward 50%.
Yeah.
Okay. So if you just average that, your average rate of return was 25%.
Yeah. That's pretty good.
How do you like your 25%? But did I make any money?
Yeah.
No, you have the same money.
You actually lost money because of inflation.
And time. You lost time.
Yeah.
And that's the other key thing, losing time. In my example of 97 to 2007, if I had put the same money into policies in that window of time compared to what I did in qualified plans, IRAs, 401ks, because that's what society told me to do, my HR department, my CPA, they told me to do that from age 27 to 37. And if I had just done what we're talking about, there's a 6-figure swing in that decade. And the opportunities I missed because I didn't have any liquidity, because I was afraid to sell an investment because it was down, right? And that's where society gets trapped. So your financial pyramid has to start with cash value, dividend paying life insurance. Build that foundation, and your pyramid will give you permission to take some risk down the road. But you can't do it in reverse order like we're being told. In reverse order, you get out of college, your first job, the HR lady gives you, or man, gives you your 401k packet, and you feel like you're saving for your future. You're not. You're just not. You should immediately push back on that 401k plan and start warehousing that cash in these policies we're talking about, so you can build that foundation where you know where it'll get to your future, financial future.
Now, Mark, I guess somebody listening to this might think, well, this is all really nice if you have a lot of money. So do you think everything we're talking about is applicable only to people who are wealthy?
My clients start as low as a couple $100 a month. And I have clients that put in hundreds of thousands a year. So it works the same way, regardless of the amount of money you're going to have to work with. But the point is you got to get some money working in your favor and building that foundation and building that tax footprint. That's one of my favorite things, is knowing my future tax footprint compared to if I had a 401k or an IRA, and I don't have a clue what the government's going to do to the taxation to society in the next 10 or 15 or 20 years. But nothing shows me it's going to get better. Tax-wise.
And I think whether the economy gets better, taxes or economy, whether they both get better or worse, it doesn't change bank on yourself. It doesn't change the benefit of it. Bank on yourself is good in an upward market and a down market. And it's good in a high tax place and a low tax place. So it's not like, well, let me take my odds. Let me take my chances. You could take your chances and do bank on yourself both.
Yeah, that's exactly what I'm saying, is build that foundation first. Then we can even have some fun taking some chances. And when you actually now take those chances, the original dollars are still earning for you, which would offset any of your failures. If you took a chance that didn't work.
It's actually very simple. It's actually much more simple than people think it is. Do you have any free content you could share with the audience so they can learn more about this? Absolutely.
You can get a free chapter of my book at topwealthagenda.com. You can just log in there and download the chapter. Or you can reach out and schedule a time with me. And the easy way to do that is you would go to bookwithmarc.com. Now, the trick on that is it's Marc with a C. So MARC, bookwithmarc.com. And you can schedule 15 minutes or as much time as you want. And if any of you out there are looking for a free, honest financial audit that will also tell you where you're headed if you do nothing differently, and then also what you could rearrange or reposition and show you exactly where you would be in 5, 10, 20 years down the road with one of our plans. And again, do that by going to bookwithmarc.com.
Okay. Bookwithmark.com or topwealthagenda.com to download a free chapter of your book.
That's correct.
Okay.
Happy to help anybody that wants to learn more. The process is all about the education.
Yeah. And
Then
you can
you
help,
get to decide.
and then you can help clients in all 50 states, right?
All 50.
Okay. Well, sounds good, Mark. I really enjoyed having you on this podcast, talking about your background and bank on yourself. I'm looking forward to having you back on the show.
I can't wait. I get excited about this.
Thank you. To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN, assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.